In order to be called a tax, a levy must meet certain elements. The first element is the existence of a party that collects, namely the state through official authorities such as the Directorate General of Taxation or local government. The second element is the existence of parties subject to tax, called taxpayers. Taxpayers can be individuals or entities that meet the provisions of tax regulations. The third element is the legal basis. Taxes are collected based on applicable laws or regulations, so that the collection has legal force and is coercive. The fourth element is forceful nature, meaning that everyone who qualifies as a taxpayer must pay taxes and cannot refuse them. The fifth element is the absence of direct rewards. Taxpayers will not receive certain goods or services in return for the tax they pay, but will feel the benefits in the form of public services. The final element is the purpose of collection, which is to finance state expenditure for the prosperity of the people. It is important to understand that paying taxes is not only a legal obligation, but also a form of active participation in building the country. High tax awareness in the community will make state revenues stronger, so that the government can run more development programs and public services. Unfortunately, the level of tax compliance in Indonesia is still a challenge. Some of the contributing factors include lack of public understanding of taxes, negative perceptions due to abuse cases, and the persistence of tax avoidance practices. To improve compliance and improve the tax system, tax education is expanded. Digital technology is utilized to facilitate payments and reporting, and incentives are given to encourage certain sectors. In recent years, tax policies are also directed to support sustainable development goals. One of them is by providing tax incentives for companies that develop environmentally friendly technologies or produce goods with low carbon emissions. This policy is in line with the vision towards green industry, where economic growth not only relies on increasing production, but also considers environmental sustainability. By understanding the definition, types, and elements of tax, we can see that tax is not just a financial obligation, but an important foundation for the progress of the nation. Properly managed tax will provide broad benefits for all people, finance various development needs, and ensure sustainable prosperity. In the end, awareness and compliance of every citizen in paying taxes will be the key to realizing a more prosperous, equitable, and competitive Indonesia in the global era. Taxes are mandatory contributions from citizens to the state that are coercive based on law, without direct reward, and are used to finance state expenditures for the benefit of the people. Taxes become one of the important pillars in development. Without taxes, the government will have difficulty financing education, health, security, infrastructure, and various welfare programs. We may not experience the tax benefits directly each time we pay them, but the existence of highways, bridges, schools, hospitals, and various public services is a tangible result of the taxes we pay. Taxes have a dual role. On the one hand, taxes are the country's main source of revenue used to finance routine expenses and development. On the other hand, taxes are also a policy instrument to regulate the economy. For example, the government can raise taxes on certain items that are considered bad for health or the environment, such as cigarettes and alcoholic beverages, to reduce their consumption. Instead, taxes can be reduced or given incentives to encourage investment in sectors that want to be developed, such as environmentally friendly industries or renewable energy. The type of tax in Indonesia can be seen from several points of view. When viewed from the institution that collects, taxes are divided into central taxes and local taxes. Central taxes are collected by the central government through the Directorate General of Taxes, and the results go to the state treasury. Sales tax on luxury goods and stamp duty. Local taxes are collected by local governments, both provincial and district/city, and are used to finance government operations in the region. Examples are motor vehicle tax, hotel tax, restaurant tax, entertainment tax, and advertising tax. When viewed from its nature, taxes are divided into direct taxes and indirect taxes. Direct taxes are taxes whose burdens must be borne by the taxpayer himself and cannot be transferred to other parties, such as income tax paid based on income received. Indirect taxes are taxes that can be transferred to other parties, usually through the price of goods or services. An example is value-added tax charged to consumers when buying goods or services. In addition, based on the object subject to tax, there are various types of taxes. Income tax is imposed on income received or obtained by the taxpayer in one tax year. Value-added tax is imposed on the consumption of goods and services in the country. Sales tax on luxury goods is imposed on certain items that are considered luxury, both because of their high price and non-basic nature. There is also stamp duty, which is imposed on certain documents that have legal value or economic value.